Good morning. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz, Tom and John off today. I am so lucky that I am greeted with Damian, Sassower, and Gina Martin-Adams, who are still with us, even despite the fact that I had to up the bribe. I really appreciate you guys being there. It seems like a tumultuous week. And I started by saying, our bonds and stocks sending a slightly different message because we've been talking about this. It seems like bonds are saying strength and resilience. Stocks actually not so much.
Yeah, or stocks are just reacting to bond market yields. I mean, it's very difficult to say because it doesn't look like there's been a massive shift in the earnings outlook or the economic outlook to stimulate the decline that we've seen, yet sentiment was a little bit irrational in the middle of the year. And we've seen a major pullback as yields have accelerated quickly. So it could just be that this new correlation that exists now between equities and bonds is really playing out and playing out in a negative fashion for equities.
Yeah, no, and I mean, sentiment's just being one part of the equation. We get a lot of data this week. You get a U.S. data dump, we get ECI, we have payrolls, we have the Fed, we have the QRA. It's just going to be interesting for me to see how sentiment can hold up as well as it has in lieu of all this.
Let's parse through some of the acronyms. So we're talking about employment data with its employment cost index. We're talking about the potential for how much debt the U.S. is going to have to add to the current debt pile without the Fed necessarily buying. But we're also talking about just the nuts and bolts, the fundamentals of the economy and how central banks view that. What's most important? And we keep talking about this and everyone says it's all of it, right? And then at the end of the week, everyone says it was the ECI that did everything. It was the University of Michigan Sentiment Survey. What is that one key thing that could really change the dial?
Look, I don't know that there is one, but one thing you didn't talk about is Apple earnings. And I'm going to keep coming back to the fact that ultimately stocks are the value of future earnings stream, right? So ultimately, you're getting an ownership in a company. What the companies do with their earnings will matter to equities. So Apple, being one of the biggest stocks in the world, is very important and consequential. We need to continue to see relative stability out of the earnings stream to really see stocks hold up.
But it points out that Apple and stocks are not the economy because the stock market is basically Apple, Microsoft, Google, Amazon, et cetera. They're doing fantastically. Everyone else is struggling. How are you expecting to see that really play out in the other areas? And that, I think, is one of the key questions.
Yeah, no, I agree. I mean, it's interesting, though. It's not just about tech. It's about UPS, right? UPS is a good barometer of economic sentiment. And, UPS didn't even come in so healthy. So, I guess there's a lot to take away from earnings. But you're right. I mean, tech, I think that's the leader here. And to see what's going to happen this Thursday with Apple is definitely going to be a market driver.
And let me just reiterate something you said, Lisa, because this is something I think investors completely forget half the time, is the economy and the market are not the same thing. Earnings are not necessarily directly one-to-one related to what's happening in the economic data. You've got to really parse through the economic data for what's meaningful. Going back to another conversation we recently had, if you get caught up in the 250 different economic indicators that you're expected to follow on a monthly basis, you're going to miss a lot of opportunities in the equity market. What's really meaningful is really important conversation point.